Welcome to Growth and Exit Strategies for Software and IT Companies, the flagship tech conference of the World Financial Symposiums. The GXS conference caters to tech founders and investors in tech M&A, covering topics like investments, growth strategies, buyouts, sales, divestitures, and mergers. Thank you for joining us. Let's begin.
Now it's time to move on to the buyers panel, moderated by Amber Stoner, Vice President at Quorum Group, answering key questions such as, what are tech buyers looking for in today's market? And how can you build relationships to capture maximum value?
Thank you. Welcome to the GXS Women in Tech Buyers panel. I'm very excited to have these ladies with me today. We're going to jump right in. Let's start with some introductions. So just briefly, what's your current role? What are some of the fundamental characteristics of companies that you invest in? And are there any deals that you've been involved in recently that you can and are excited to talk about? And let's start with you, Cass.
All right. Hi, everyone. I'm Cass Ebel. I'm a principal at Parker Gale Capital. We're in Chicago, in the West Loop of Chicago, so great food. And we invest in founder-owned, so usually first institutional capital in a founder-owned tech software-enabled business. We do lower middle market, so we're looking at things as low as maybe $5 million in revenue, depending on if it's an add-on acquisition to a larger platform, to maybe something as big as $30 million in revenue. Tends to be about the size that we plan for our check sizes. And any deals that we've been involved in recently, well, we did just exit if you would believe it, a fax business in the year of 2023, December 2023. A couple months ago, we actually bought 2 years prior, exited on its 2-year anniversary, a fax business out of Boston called Bizcom, which was a wonderful success story. At the time we bought it, a 91-year-old founder who has been super successful in his career. His son, Bill Ho, was running the business. And we had the opportunity to put in a completely new management team and watch the business flourish in 2 years. And fax, who knew? But it's one of the most secure ways to send files, and is still thriving in the hospitals and healthcare industry and financial industry. So, yeah.
All right. Thanks, Cass. Carolyn, how about you?
Hi, everyone. I am the managing partner and I run operations as well for a group called Emerging Capital Partners. We're global. We've been investing since 2000. We have raised and fully deployed about 9 funds, which were put into over 60 deals, and we have completed over 46 full exits. So that's our full track record. Today, I'm working on the sale of a big fintech platform, and we signed the sale last year. The performance dipped a little bit, so we're pretty much arguing over valuation, whether we get to keep the methodology the same or does it get modified, which would bolster our sales price process. So that's up to the minute.
Thank you. Krista, over to you.
We're also working on a sale where there's something went wrong and we're arguing over valuation. I think that's happening a lot right now in the M&A space. So I'm Krista Morgan. I'm a general partner at Stage. We're an early stage private equity fund. We actually operate a little bit more in the distressed area. So we buy software companies that have lost their venture funding and are trying to find a new path, typically buying companies with sub $10 million of revenue, usually burning cash, usually just need to be restructured, get a new, really new balance sheet, new cap table so that they can fit a non-venture model. We're investing out of our second fund. we are trying to sell so we started 4 years ago. We're actually we've been trying to sell our first company, which has been an adventure. And then we're actually buying some interesting stuff we're working on. We're seeing a lot of companies that have been somewhat displaced by generative AI and are having to rethink their business models, and consequently are in a distressed situation. And so I think just interesting trends. And obviously, as you can imagine, we have a lot of deal flow right now, given the state of venture.
All right. Thank you. Letitia, would you please introduce yourself?
Yes, thank you very much. Hi, my name is Laetitia. I'm based in Geneva, Switzerland, working. Very, very nice to meet you all today and to be part of this panel. And I'm working as a senior manager within the corporate development and merger and acquisition department of a group called CETA, which is a kind of 1.6 billion revenue company that is main activity is providing software for the air transport industry. So what we are doing today is that we have a very strong acquisitive strategy, objective to buy more than 250 million revenue over the next 3 years. So we have a lot of work, and what the company we're investing in are mainly company that are above 20 million, which was not the case before. We switched a bit the strategy from small businesses to larger ones. And in our industry, so air transport, and more generally transport. So we can go into maritime and rail, but overall we stayed in our industry. And one deal I've worked on, and which was kind of interesting, is that it was the first time that I worked on a minority deal. So it's not the core business of our merger and acquisition, but it was very interesting. And it was in the drone and eVTOL business. So we invested in Volocopter in Germany, and in a company that is also manufacturing drones, but also organizing the operation around drones. So it's very prospective, but help us to try to think about how we'll operate the airport in the future. So very interesting and challenging questions.
Fantastic. Thanks, Letitia. And last but not least, Meg.
Thank you. Thank you for having me today. Meg Baldini. I'm with a company called Procore Technologies. Procore is a SaaS platform for the construction and sort of built world vertical, from pre-construction through closeout. I lead corporate development for Procore, so that includes M&A, deal execution, integration of acquired companies, a CVC motion that we're running within the business, as well as our ecosystem and partner strategy. I don't know that Procore's been, relative to a 20-year history, we haven't been that acquisitive. It's roughly 10 deals to date. We look at everything from an acqui-hire or company with a couple million in revenue through, say, 400 or 500 person companies with up to 30 million plus. A lot of that, I will say, just has to do with the maturity of our industry. It's certainly a newer area for investment and for technology. A deal I'm proud of. I think getting deals done quickly is always the goal, but there are typically things that slip or, kind of move out that calendar by at least a week. I'm pretty proud of a deal we were able to get done really close to 3 weeks, just in time for our user conference earlier this year, a team called Unearth. I think the deal execution side, it was really great to see the team come together and make it happen in record time. And then in terms of impact, it's been just so rewarding to see the leadership that came in through that deal already having an outsized impact inside of the business.
Great, thank you. So the next question I have for all of you is, from your perspective, is there a right time to buy a company? And Krista, let's start with you.
I know So is there a right time to buy? I mean, look, I think it really depends what you're looking for. For us, for me, I think it really comes down to, especially in the distress situation we're in, is everyone at the table kind of ready to accept where they are and ready to get a deal done. I was a founder, before I became a GP, and there's just so much I didn't realize just so much emotion and things that are going on that have nothing to do with the deal at hand. And so for us, the number of times I put in an offer and someone just says, I just can't, I'm just not there yet. Let me call you later. And you just say, yep. And so you just got to wait. There's this tipping point that everyone around the table wants to get a deal done, because depending on the environment, you may, you sort of have to accept the realities of the environment you're in and what that deal is going to look like.
Absolutely. Meg, do you want to comment on that?
Yeah, I don't think, whether it's private equity, whether it's being acquired by a strategic, I don't think there's necessarily, everyone's got an M&A playbook, but I think timing is probably the most snowflakey piece of it. When times are good in venture, right, you want to make sure that you're not buying the day after you close a round, because, that growth is essentially priced in. So that's at least one bookend. But yeah, I think it, at least from a strategic standpoint, really depends on the build versus buy thesis there. Does it make sense for us to buy this technology now to accelerate a go-to-market, to accelerate a competitive offering? Regardless of potentially, just the kind of balancing what's the price today, what's the upside in the future. I will say, market timing is interesting, because it was, wasn't that long ago, 2021, we were seeing some of the highest multiples in the history of the internet. So hats off to all the founders that sold then. And then it's an incredibly different environment now, right, where you're able to get some multiple compression, and it's just not as good of an outcome for founders. So it's a little bit of a balance. From where we sit in as a strategic, you want to make sure that you're doing right by the strategy, by your customer. So making the right decisions there, but also making the right decisions to keep those founders happy. So if, maybe they're not getting the outcome that they wanted from a financial standpoint, what could you do on the equity side to keep them invested in the business and excited to stick around? Those are just a couple of thoughts that come to mind.
Thanks. Cass, how about you?
Yeah, I feel like it's one of those things where there is never a right time necessarily. So echoing a lot of the earlier sentiments, because there's just going to be a nuance wherever we are at in a cycle. Similarly, on the flip side, there's never going to be the perfect time to sell. Maybe it was in 2021. But you don't know that when you're in it.
Time to sell.
Exactly. That's true. But you kind of didn't know that, because in 2021, you were probably thinking, well, what about 2022? What's next year going to bring? Am I going to get what I want to get? And so I think in terms of right time to buy or sell, similar to Chris's sentiment, it's who's prepared emotionally to be at the stage that we are in the cycle, to be prepared for that. And I also think a lot of things play into it that are outside of the elements of just pure economics, right? There's, we run into, since we do buy founder-owned businesses, we're often running into personal situations and people who are wanting to retire or wanting to spend more time with family, or just different things that come up that all play a factor into, is it the right time to buy? Is it the right time to sell? And with, similar to Meg, when we think about our add-on strategy, thinking through, do we want to bulk something up very quickly and then think about integration? Sometimes that's the right move for us. Sometimes being methodical and turning things down and adding companies on slowly and integrating them as we go is the right move. So there's really every situation is a special snowflake, but it all comes with their own nuances. So it's the short answer is no, but also 2021 was the right time to sell, maybe not the right time to buy.
Fair enough. Carolyn, how about you?
Sure. All of those points apply to my portfolios, certainly. And I would add on to what Meg said, that you don't want to buy right after a round closes. So we love to get in pre-round and see if we can add something, some value, or then get that uplift pretty quickly on the subsequent round. I would also add that we will look at an overall portfolio. So per fund, if we want to invest in 12 to 15 deals, if we're at the end of that construction of the portfolio and we've done 12 deals, we will sit down and look at the risk profile of those deals and then adjust maybe the last 3 deals. If it's a risky looking profile, we take 2 to 3 years to put together our portfolio. We can take a little less risk and do something that's a little blah, we're not swinging for the fences. If it's a pretty, strong and steady portfolio, we might take some bigger blue sky. And interestingly, Laetitia, we just did that with a big drone company too, and that has really worked out for us. So 2 additional factors for me.
Fantastic. And Laetitia, how about your thoughts?
I think it's a difficult question. As a corporate, and we are working in the investment of the corporate, so we are always ready to buy, because that's the core of our business. So we are by definition always ready. But the problem and that we are facing on our side is to find the right target that fits our strategic objective, and we have different business units, and they have already their strategic plan, and they want the perfect fit, and the problem is to find the match between the target that are available and our strategic fit. So that's really an equation that we need to work around. And on our side, the main challenge also is to find the right stage of the company to buy, because we were more in the past looking at small companies with 1, 2, 3 million with a growth perspective, and but a lot to do, a lot to deploy with our own sales force to make sure that they had a very good technology, but all things needs to be developed and materialize. And that was a kind of complex phase with a lot of challenges in terms of integration, growth. So very exciting, but very risky. And now I think we are moving a bit more on findings, target that are more in a more mature stage with probably a bit less growth ahead, but more stable profile. So I think it's also depending on why you are buying and what is your objective. And I think depending on corporates and private equity can change a lot.
Sure. So now that we've talked about timing, what advice would you give to a tech entrepreneur who is looking to prepare themselves for the M&A process? And can you give some past examples where sellers have gotten it right, and maybe some examples where they've gotten it wrong? Let's start with you, Meg.
Sure. I think at the highest level, as an owner of a business, as someone looking to sell an enterprise, it's getting really clear on your goals. Because there's lots of exit paths, whether it's private equity in more of like a tech roll-up play, whether it's selling into a strategic where you're becoming kind of the next kind of strategic pillar or component of that of the broader strategy, and getting really, really tight on, what that would mean for your team, what that would mean for kind of the future of your vision. I think when founders don't know what they want, I think that's probably the hardest group to work with. Because you're trying to build a win-win, but it's unclear, or anyways, M&A is an interesting one. It's a dating relationship, and you got to put it all on the table. Other things just in general, and in preparing for an M&A process, we could get into the technical and just how you run a business, and the folks that you've brought on over a period, your burn rate, making sure there's a really clear ROI path. But the biggest one for me is understanding where you want to go. And then secondarily, aligning yourself to that vision. So building the relationships that you need to early. So it's not, I think the deals we like least are, these very sterile banker type processes where everyone's coming to the table and putting up a number versus a conversation that was probably started years ago and is the natural evolution of a relationship. A little different from where I sit as a strategic, but I'll kick it back to the group.
All right, thank you. So Carolyn, your thoughts?
Yeah, it's interesting that Meg refers to a relationship. I always liken it to a confirmed bachelorette who is declaring that they want to get married. You really have to be ready for it, because once we're an equity owner, we're really in the family, as we like to say. I think I would give some additional advice, which we give to our entrepreneurs. And that is, what value are you looking at of our capital in particular? We like to tout that we have, because of all the companies we've invested in, a really large global network. So are you looking to connect with other customers or investors or go into new markets? I think that's a big value add for us. Are you just looking for a deep pocket? Our check usually is pretty much what it is up front. We will do follow-ons, but we're not the deepest pocket in the world. There are deeper. Or are you looking for our experience, looking at our portfolio, what we've done with other companies? So we've invested in some pretty exotic markets, French-speaking markets, and it's a 25-year history. So you can see what you're getting with our capital. In addition to financial engineering and all sorts of Black-Scholes models and capability, we do offer a particular type of capital profile.
All right, thank you. Krista, how about you?
I don't know if I have a ton to add to it. I think I would just, in terms of knowing what you want for us, especially if you're talking about a distress, like, so if you're showing up to the table and like this is not, you're selling probably more because you have to versus because this is your optimal, outcome. I think really understanding like your priority of needs. Yes, we want all of these things, but what are the most important? And can you surface those earlier? Because we were looking at a deal recently where we got really far down the road, and at the last minute, the founder's like, actually, also, I need you to guarantee severance for our entire team if you fire anyone for a year. And I was like, that's a big, and she, the deal died on that. And I was like, if that's where I told you we're probably going to let people go, 3 months ago. Like, why has this waited? And I think that, and because it really sours the relationship. I think as an investor, you're just like, why? I would not, neither of us had to waste all this time, being here. So those deal kill, and I think, and I don't, maybe they hadn't surfaced early enough. I asked myself, like, how did I not uncover this in the process? But yeah, those things, like, what is the thing you really need? Because getting a deal done, distressed or not, it is a huge emotional and financial operational lift. Doesn't matter the size of the deal, it's a big lift. So being really clear about what is the number one or two things you need to get through that is critical.
Absolutely. Cass, your thoughts on this?
Real quickly, I'll follow on to that, Krista. I think I've seen a lot of deals fall apart on these just death by 1,000 cut negotiations, where things just pop up and pop up and pop up and keep popping up later. And that really disintegrates the trust that you build up going into a process. And trust is built in layers. And so I think if you're thinking about selling a business, there's a negotiation strategy of just putting it all out there and everybody seeing what the pie looks like instead of just piece by piece by piece that can help preserve some of that trust from the jump. But obviously, if this is your first and potentially only time selling a business, you're not going to know everything going into it. You're not going to know how you feel 3 weeks from now or a month from now into this. But the more you can be in that mindset and have those things all laid out, the better it is for your own negotiation and your own strategy and your own trust as you're working with the other side. I also think, and this is a little bit selfish, because after we buy businesses, I work a lot on reporting and working with our CFOs. But I think there is a lot of value in getting your data, your numbers, your reporting in a really tight place before you go to sell. And I've been on the flip side of that. We've sold a couple of our businesses as I've been working, arm in arm with our CFOs as we go through a sale process. And we call it the customer cube, being really tight on who's buying what, how much, year over year, how has that changed? What are your retention numbers, your basic financials, what's recurring, what's not recurring, knowing where your contracts are, just a really tight reporting and finance and accounting department. Because what usually happens with a lot of the founders that we work with when we're buying a company is the first time they're kind of getting this together, they never really wanted to invest in a person to do this in the business, because they'd much rather hire a salesperson or somebody doing go-to-market who's bringing in the dollars. But I would argue you're going to get that multiple, or you're going to get that return and that value in hiring somebody who can help straighten those things out sooner. A lot of times you'll bring in somebody to help you do a quality of earnings. You might bring in a third-party accountant. Oftentimes, if you do an investment banked process, they're the ones digging through your data. And then it's the first time that you're seeing some of it. And then you're trying to tell the story in reverse. Like, you see your data get spit out to you from your investment banker. And right before it gets sent out the door to a buyer to look at it, you're looking at it for the first time. And that's a little bit terrifying, because you're like, wait a minute, what happened in 3 years ago? And why did this number drop? And you don't know, versus if somebody had been in that seat, you had been consuming that information for a year, 2 years, 3 years ahead of sale. It is just much easier to pull that information. It signals all the right things to the buyer that you have your life together, even if you don't. And just getting a lot of that undervalued kind of back office work in check is huge.
Thanks, Cass. Letitia, how about you?
I think I very agree with what Cass said, and I think we can even go further. My advice would be to say, okay, take advice, ask people, ask advice, or even if you do not retain them at the end, pitch are done for that. So do not hesitate to request assistance and help. At least it will guide you and help you to ask yourself the good questions in terms of presentation of the financial, legal structuring, tax structuring, that kind of simple stuff that could break a deal from the beginning. So I would say, yes, that kind of preparation phase is very key. Find the right timing also to sell. Need to find the right stage of the company and clarify, as Meg said, your expectation. What do you want to do with this sale? And make sure that you align with your shareholders. I got a deal a few years ago that was very complex to manage, because they haven't sold before launching the sale. The different interest and diverging interest, especially between the founders that wanted to stay within the company and the private equity, 3 different private equities with totally different view, interest, so vision. And it was very, very complex to manage. And I think if it would have been solved before, it would have helped and brought a lot of more. It would have been very more relaxed during the sale process because it was kind of difficult. So that would be the kind of advice that I could put forward.
Fantastic. So let's talk about valuation. And I know this is a complex question, but how do you go about valuing a company? And are there kind of common misconceptions among sellers that you've seen about valuations? And Letitia, we're going to go right back to you on this one.
So yes, this is a complex question. So I think the first question, the first point is, as part of the preparation, if you can consult some investment bank that will help to clarify and give you some insights about the valuation that you can expect. Sometimes a bit on the upper side because they want the mandate, but you will have some indication that you can follow the type of transaction, because sometimes the main risk is that you just point out the transaction that seems for you a kind of comparable transaction. And because the multiple are amazing and you really think that you can sell your company with the same, but you do not know the context. So having only one or two comps can lead to a big disappointment at the end. So and in terms of valuation, I think there is no magic here. It's we are doing a discounted cash flow, but also multiples. It's at the end the truth in terms of valuation is in between the different methodology. Of course, compare comps are very key, but we try to find also the right way to involve the business case that was put forward by the company, understand what we can do better, how we can accelerate. So there is the core value of the company, and then as a corporate, there is the kind of synergy, also the dis-synergies that could be put on the top. So, and as a buyer, we try to buy the company for itself and not to value too much the synergy and to keep that for us. But we need also to take care of the competition on deals. So I think it's this kind of complex mixture, but I'm sure that the other panelists will have a lot to say on this point.
I imagine they will. Carolyn, let's go to you.
Sure. In addition to what Letitia said, we tend to look at the industry. Some are fintech, some are tech logistics. There's drones that have assets. It depends on if it's an asset light business or, just depending on cash flows. So two things, we will always do two or three methods, and they will vary depending on the sector, but we'll always do a DCF. I would say we have tended to look at projections, which everyone on this panel looks at. And if they're really wild, it doesn't really bode well for us to get a deal done. So no matter what the projections are, we're going to knock them down. But anybody putting out really crazy projections, sometimes that gets back to the earlier point of, are you really ready to sell? We are not in favor of that kind of feeder off the ground and you're projecting something that seems extremely unrealistic, either just in general or based on your recent performance. So those are the 2 points I would put out there.
Thanks, Carolyn. I know we at Quorum, when we're talking to our clients, we want to be very clear with them that when you are making your projections, let's not go crazy and make sure that you can actually back up these projections with your pipeline or things along those lines. So very good advice. Meg, your thoughts?
Sure. I think a lot of this has been covered by the group, just high level, what are the what's the upside as a strategic? What are the things that you can uniquely do, whether it's taking a product and kind of plugging that into an existing go-to-market, where's the value there? It's the basic measures that we've talked about, DCF, and trying to understand what is your multiple on top line, what's your multiple on profitability. I just have to reiterate what Carolyn just said. When businesses come in and say, I'm going to grow 40% next year, but I'm going to, potentially cut 15% of my workforce, and there's a cost to growth, right? There's a basic run rate cost to growth. It always strikes me as odd because from our side, we're going to sit down and do capacity models. We're going to go bottoms up. We want to look at attainment over the last 3 years. We want to understand your ramp times, retention rates, what causes a logo to churn, what causes a customer to renew. And I think, the other big component is just the market, what are multiples for your specific sector, industry, and something happened recently that's been driving those up, and you can ride a wave, or the reverse. It's I wish it was a science. I wish it was a perfect science. It's a little bit somewhere in between all those.
Absolutely. Krista, your thoughts?
I think we definitely look at it differently. The two things I would say that I think people that are selling don't always understand is, one, like, liability assumption is really part of purchase price. Like, understanding, like, for us, how much like AP you've been building up, how much debt you have on your books. Like, because a lot of in our distress environment, we're absorbing that, right? And so people are like, well, you're not paying me very much. I'm like, right, but I'm absorbing, $4 million of liability. Like, that's real cash that we're going to have to put out. So I think there's some like just things that don't seem like, call it purchase price, that are, and then also just really like understanding the difference of like cash out, right? Just cash, the actual value of cash in our minds is very different to like, and even an equivalent liability assumption. Like, we see paying someone $1 million to be a very different risk level as absorbing $1 million of debt that we are in control of how we pay and how we manage it. And so we're often getting asked in transactions like, well, just trade me, just give me this $1 million. And, so that they are seen as equal, and they really aren't. And then I guess in our world too, like, founders get really caught up in the valuation number. And I'm like, look, like, there's more to it than that. It really is also like, what is the go forward look like? How much cash is going to be invested? What is your future upside if you get this deal done? Like, it's so much more than just the number on the paper. And I think that sort of letting go of your emotional attachment to that number is, I think, critical, especially like in the world that we're living in. I think, frankly, a lot of tech companies in today's valuations, regardless of whether you're technically distressed, the valuations today just are not what it is. And, your 2021 valuation on paper is probably going to be hard to match right now.
Thanks, Krista. And Cass?
Yeah, I mean, I can't add too much to what's already been said. We do a lot of the same similar evaluation methodologies. It's just as much of an art as it is a science. And I would say, to Chris's point, we think a lot about how founders think about what the value is of their business. Because at the end of the day, like, they're not going to sell until they feel like they are properly paid for all the hard work they've done. And like, that absolutely makes sense. So I would say, just from the founder's perspective, something to think about is, if you can like detach yourself from that hard number on a piece of paper, but you can communicate what that number is. You can try to dig deep and understand why you feel so attached to a certain amount. And there are other ways to get there, through post-acquisition, through leaving some roll on the table, through a note, a loan, through future compensation, through earnouts. If you truly believe that you, like, nobody else is giving you credit for this trajectory you are fighting for and truly believe in, there are ways to structure a deal to give you the upside on top of a valuation that you might not necessarily be, cheering up and down about. So there are ways to get there outside of just that initial valuation conversation. And so just digging through and thinking about, why are you so attached to this number? What are other ways to get there really does help when you get to the negotiation table.
Thank you. So let's talk about due diligence. So just talk a little bit about your due diligence process, kind of what percentage of transactions don't make it through DD, how long does that process typically last, and what are some things that can be uncovered in DD that end up being deal breakers for you? And Carolyn, we'll start with you.
Great. For us, due diligence is very expensive. Our investors like a wide variety of advisory due diligence done, and it's growth private equity. So before we launch our due diligence, we're likely to have already had 2 to 3 full investment committee meetings with very robust presentations by the deal team. And if it gets through all that and we get to due diligence, we're either going to do the whole scope or step it. What were the biggest issues identified? Was there already a VDD? That's a virtual due diligence. And what do we think of it? Are we in a round with other investors? Could we share the costs? That will all matter. Once we really fully launch, we do tend to go all the way because this has been a big lead up to it. And I'm very interested to hear what my co-panelists say about their due diligence and whether that's also the case.
Thanks, Carolyn. Letitia, how about you?
I fully agree with you, Caroline. We don't go in due diligence without being very motivated in the acquisition, because it's time consuming. On our side, yes, also advisory, but also internal people. Usually the team of the due diligence is huge between the advisory. So it takes approximately 4 to 8 weeks, depending on if the process is competitive or not, if we are constrained in the due diligence, or if we put ourselves some constraints to time box the due diligence. But even for small companies, we are investing a lot of time and money in due diligence. So I agree with you. When we go in due diligence, the percentage of due diligence that the transaction that do not make through due diligence is relatively low. Sometimes it's competitive, so you are not the chosen buyer, and that's not your choice. But when we exit due diligence because we found something that is not manageable, is really low. I think below the 20%, below 10%. And I agree with you that when we have big issue, we face due diligence, and that's I think a very important thing to do, especially when there are some constraints. When we are looking at listed company, when we have not access to management before, the first thing is to meet management and to see if there is an interest to go further in the due diligence. And last time we look at listed company deals, and after meeting the management, indeed the company was absolutely not where we thought, and we stopped. But the due diligence almost not started really. So we try when we have big issues to tackle them at the very beginning of the due diligence process.
Sure. Cass, your thoughts?
Yeah, due diligence is expensive. I will agree, and phasing it is very important. And I think agreed on all fronts on what my fellow panelists have said so far. But I would add, for us, different from a corporate buyer, potentially like we're going to also do a lot of commercial due diligence and breaking down and understanding the market, usually with a third party provider, to back up the work that we have already done on the market. Whereas like a corporate buyer might be in that exact same market and may understand it going in without having that extra step, money, time. And we're definitely going to be doing a quality of earnings, and that itself lasts, 3 to 5 weeks. And that's a pretty quick turnaround time. And that's just a fancy, way of saying like, are you, when I buy this business, what is the financial profile? What am I actually buying? What number should I be valuing this business off of? Taking out, the one-time random things that have happened in the past 3 years to really understand the business model that I'm buying. So those two for us are pretty non-negotiable. And then, you get down, it's like a dance, it's like dating, it's, as you get closer, there's still, customer calls and things that are a little bit more sensitive, but are really important to understand when you're going to buy a business. Like a huge risk factor would be, what if some of your most valuable customers are going to leave within the year? And so just understanding the relationship the business has with its customers, all of these things take a lot of money and time. And I would say that we're pretty nimble. We're a small shop. There's, 15 of us. Our deal partners are involved heavily from the jump. And, it still takes months to get a deal done. Even with as quick as we can go. It's very distracting for everybody, and you can only move at a certain pace. And so there's that. But I would also agree, the further you go down, post LOI, it is really where the deal would fall apart. And the only reason that it tends to is, going back to a major breach of trust issue, or, something that just pops up that either was completely unexpected on both sides or on one side, that kind of completely changes the elements of a deal, would lead to a totally different valuation. It's rare, it happens, but it's rare. But that's usually the case when something falls apart that late after so much work.
All right, thanks. And Meg, with you being on the strategic side, do you have any kind of different advice or comments on that side?
Yeah, I think I'll just echo what everyone else has said on this one. Our diligence process will very much depend on the size of the deal. Like I said, we can do it in under a month, or maybe there's antitrust involved, and you have to go through the regulatory steps to get sign off. So that could be several months. Our world is definitely moving very quickly, so we try to aim to complete transactions as quickly as possible. Also extremely intentional around M&A. I would say what's different for us is we manage a ecosystem of over 500 integrated technology partners at this point. So we know what those names are. In a lot of cases, we have a joint selling motion. We know what the product market fit is. It's a huge distraction for our strategic. Right, there are existing roadmaps, there are things going on. So if you're going to start to tap folks into a diligence process, you need to be serious. The other thing I'd probably highlight is folks are talking about a stepped function. One of the reasons that's so important with diligence inside of a strategic is because there's almost like a sunk cost with diligence. Once you get going, your bias is to move it forward. And as you find flags, what's just really interesting, even from a psychology perspective, is you're like, okay, well, we've already done all the work. Like, I'm sure we can work through that one too. So my goal in diligence is to not be surprised by anything, have those relationships in advance, have a full thesis, understanding of how that business works, and then test it. The things that really break things apart for us, people have said death by 1,000 cuts. I think no matter what type of buyer you're going to, showing up at the last minute with surprises, that's just never a good look. But other things for us is cost to integrate. So if we think it's going to be one thing and then we find out your tech stack doesn't scale, or there's a lot of dependencies. So you have like an outsourced team in Sri Lanka that we didn't fully understand. There's some employment issues. in a different country, I think those are like really tough to work around, especially if you don't have the lead time to build a contingency plan. Also, as a strategic, I would say, like, culturally, we want to keep our founders around for a long time, and we want them to continue. It's a talent play still in this space, and making sure that we can bring that talent in and keep them around, that it's going to be a good fit with the rest of the team, is also pretty important for us. So, I mean, about 10 deals to date, I would say 100% of those have gone. If we get to LOI, we will most likely, actually in 100% of cases, we'll get to close. But can't speak to some of these other business models, but in our case, there is a whole iceberg of things that happen pre-LOI to make sure that we're not wasting anyone's time.
Fantastic. And finally, over to you, Krista.
We actually, given the circumstance we're usually in, we often have to do more basic confirmatory diligence, which is why we're reluctant. We're not putting a lot of cash out up front. I think that's something I would say that, the more, if you're showing up to a deal where you really have to get a deal done in a certain period of time, and you're kind of hamstringing the other side in terms of how much time they get to investigate the business, that is always going to lead to a sort of less favorable valuation, and you have to price that in, to the deal. We've done, the number of times, like, we're given less than 30 days to get a deal done, and we have to say, look, like, this is a take it or leave it. We'll do what we can. We're trying to just understand the biggest risks in the business and price as much of that in as we can. But it's less sort of, we can't afford to have a very robust process, basically, if we want to get deals done, right? Like, I think as an investor, in the space that we're in, if we get known for coming in and needing 3 months to get a deal done, well, no one will bring us like deal. And once we commit, we have walked away from a handful in diligence, but it's rare. And I think we've only triggered it one time, because for us, there's reputational risk. Like, there's usually more to just that deal that is going to cause issues for us if we don't close.
All right. And Meg, you kind of mentioned this, but what does your typical post-acquisition employment agreement look like? How long do you typically like to keep key executives on? And we will start with you on this one, Meg.
Sure. I think definitely there's been an evolution there. When Procore was a smaller company and almost like a rapid growth startup itself, a lot of founders could come in and build an entire second career here, own a new product line, or really be like the go-to-market lead on something. I think it really depends on, this is another snowflake example, where depends on the interest of the founder. I think we've all met founders who like to be founders, like to be entrepreneurs, a jack of all trades, and that's just harder when you're plugging into a bigger organization. And then you meet folks who really want to stick around and see their vision through. So we try to structure deals. This goes back to being really clear about your goals and what you're looking to do over the next few years. Because in some cases, we'll structure an agreement post-close around the value drivers. So say over a 1 or 2 year window, if you hit key milestones, whether it's a go-to-market component, whether that's a technology integration component, then there's additional value that you can unlock there. Just making sure that we keep our interests aligned. And then in other cases, right, maybe it's a category opening solution for Procore, in which case, right, maybe the leadership on that team are essentially becoming their own leadership squad within the business. So really depends. I would say early on, we probably retained every founder. And as we get larger and bigger, it's an acquired taste of if you want to be at a big company or not.
Fantastic. Letitia, over to you.
Thanks. I think it's a chemistry. It's difficult to say in advance, and you need to adapt all along the integration process, because founders and top managers can say something during the transaction and change their mind when they discover how things are going on the good way and on the bad way too. So usually on our side, we have a period of 2 years that is a strict minimum, because to ensure a transition and to ensure that we are able to also take over. So over the past acquisition, we secure through earnout when possible. So that helps for the management to stay. We also put some retention package in place where we think that this could be of help. And during due diligence, we are also trying to assess the cultural fit, because losing people, especially when you buy a small company, which was the case in the past, is a high risk. There is a high risk on people, and we need to manage that correctly. Otherwise, you lose your value in a year. It could be very, very quick. So usually we try to put some stuff in the employment agreement to make sure that they will have you. That creates challenges also. Earnouts are not easy to manage, and it's also creates some frustration, because sometimes they arrive in a big group and they say, okay, what else I can do? I can take other responsibility, but they also have the earnout perspective and objective. So sometimes very difficult to distract them from their first business during this earnout period. So it's like a transition, should not be too long too. And then you have a risk to be managed that people will leave or not. You never know. It's a bet at each closing to see and to try to estimate who will stay and who will leave, and you are always wrong. So you need to adapt each time and all along the transition period.
Thank you. And Krista, your thoughts?
This has shifted for us. I would say we now actually really try to, it's part of our deal evaluation is, do we actually think the founder wants to stay and is capable of making this shift from being venture backed to going to more of a private equity sort of moderate growth profit model, and I think is willing to like really do the heavy lift of a turnaround. But what we've seen in our portfolio is the founders that can make that shift have been the best performing and then have the option for the best outcome. So we really like to keep, because the companies are still early stage and the founder often has an outsized impact on the outcome. So we try to keep them. It does not, they don't always want to go. And then we have to make the decision, like, is it still worth buying? Is the deal still worth going ahead, knowing that we're not going to have that, call it founder effect, and we're going to have to bring someone in. So but we started out thinking we wouldn't want our founders, but turns out founders are great. Okay, if they want to continue, they have a kind of magical effect.
Absolutely. Carolyn, over to you.
Sure. I think our answer is it depends. Similar to Krista, we had one model and now we have a more diverse model, depending. So we have the first thing I say when I give a talk about what are the big lessons learned from investing in a 25-year history with these large amounts of money is that you live and die by the management team. You can have the best quality of earnings review. You can have the market going gangbusters. And this just, we have never done well if it wasn't a great alignment with the management team and we weren't all looking at the same path through the water and rowing the boat together. So that is the first thing. The second thing is where it depends. It depends on the age, the motivation, what we're trying to do. If we're trying to do more of the same and just keep growing and they just needed a little more equity to obtain a better debt profile, that's one thing. But if we're trying to shift, go into new markets, expand, that's another. Our restructurings, that's a whole different topic for another panel. That's a whole lot of learning, which I would leave to Krista, but I have been involved in very big ones. And you need the management, but you also sometimes need them to go. And that is a real art, not a science. The big lesson I would say is have the ability to make management changes because you hope and you think you've done your due diligence, but just in case, you better be able to change them around and have a really solid ESOP, a good employee stock option plan. We really are big on those for quite a large percentage of the company.
All right. Fantastic. Thank you. And Cass, your thoughts?
Yeah, it's actually really interesting. Just based on the types of deals we do and where we play in the market, we're a little bit different in our approach, I think, compared to my fellow panelists that are more inclined, it sounds like, to be worried about people staying. Most of the time, our founders are like, this is the amount of money I need to buy a boat and sail around the world. And I'm like, that is what I'm going to do. Oh, you really need me to sign this consulting agreement? Are you sure? So a lot of times for us, it looks like the founder exiting because we do buyouts. So we're going to own at least 51% of the business. We are going to be making changes. Usually we are, what is exciting and hard in our businesses, we usually are putting people in positions that actually we're not replacing anyone. There wasn't a CFO in the business. There wasn't a marketing person. There wasn't a head of people. There wasn't a customer success person. And often, I would say half the time, there's a president or somebody who's running the day-to-day that the founder has tapped. And we will back that person. So the employment agreements for that person looks like, you're going to have equity, you're going to have potentially some non-compete wording in that agreement. You're going to have severance that could range depending on your experience and how long you've been with the business. But those are the types of things that you would be looking for. And we're usually negotiating with the founders to, have some kind of consulting agreement with us. To say, hey, we need you to stay on, or we need you to stay on, help us choose if they don't have somebody kind of tapped to be that person. In the deal I mentioned in the very beginning, we bought that family-owned business, that fax business, and the CEO graciously, although he could have left and golfed every day, stayed on with us for 6 months to find the right person. And he was involved in the interviews to find the new CEO to run the business. And that was way longer than we expected it to take, but we found, the right person and it was worth the wait. But we're usually kind of asking kind of the opposite. It's like, no, stay, please help. And usually, especially if there's somebody who's rolling to, take a second bite at the apple, there's often sometimes negotiated a board role for that founder, which is extremely helpful for everybody, because there's stuff that lives in their head that you just will never pick up on due diligence, even if you are doing due diligence for a year. And so having that kind of guidance and advisory is invaluable for us.
All right. Well, wonderful. Thank you to all of our panelists. This has been a really great conversation and some fantastic advice for our attendees. So I really appreciate your time. Thank you for spending the time with us and talking about this.
To our audience, we appreciate your participation today. Visit WFS.com for more information on events coming up. If you'd like to get in touch with the WFS team, speakers, or the Quorum Group, email us at info@wfs.com.
World Financial Symposiums, the education center for tech leaders.